Hello, everyone. Well, yesterday's ECB meeting produced no change in policy stance. The Council decided to wait for more data before taking any decision. The surprise was that next month's revision of their forecasts will include the forecast for 2016. This is 9 months before they were expected. This announcement could paint them into a corner. If the ECB staff forecasts that inflation will remain substantially below their close to but below 2% target, even in 2016, then they will in fact trigger the very disanchoring of market inflation expectations that the ECB Council is so concerned about. And then they'd probably be obliged to loosen policy further as a result. In short, next month's ECB meeting is going to be a key event. The U.S. economic data yesterday was mixed. Nonetheless, U.S. bond yields crept higher, and the implied interest rate on Fed funds futures continue to climb back up slowly as fears about an EM collapse recede. In fact, emerging market equities outperformed developed market equities yesterday. Most EM currencies that I track were unchanged to higher against the dollar, and the VIX index, the fear index, fell sharply, indicating that fear is receding from the market. Now today, of course, the main event is going to be the non-farm payrolls for January. The December report, if you remember, came out much worse than expected because of bad weather lowering job growth. The weather was more normal during the week of the survey in January, so the market expects the figure to return to more normal levels at 180,000. If you want to see the impact of the weather on the figures, you should look at the construction employment. Of course, construction is strongly affected by the weather. Construction payrolls fell by 16,000 in December, but the payroll firm ADP Wednesday said private construction employment grew by a more normal 25,000 last month. Today's report will also include the annual revisions that could reshape the markets and the Fed's views of the labor market in 2013. If the data is revised up, as they were in 2012, that would improve people's perception of the U.S. economy, probably raising interest rate expectations somewhat and strengthening the dollar. The reverse is also possible, of course. Over the last 3 years, above forecast numbers have tended to engender more volatility in the FX market than below forecast payroll numbers, probably because for much of that time, investors have thought that a strong number could bring about a change in monetary policy, whereas a weak number just meant the continuation of the current supportive policy. That relationship might not continue going forward. Please take a look at the comment in the research section of our website, IronFX.com, for details on which currency pairs tend to be the most volatile when payrolls beat or miss estimates. You can also see our technical analysis there. To get this information automatically, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.